All right, what's up, guys? Today in this video, I'm going to be showing you how I swing trade breakouts. I'm going to go through the whole strategy, every step of the process, the setups I look for, how I trade them, entry, exit, risk management, all that stuff. So, enough said, let's get started. So the first step of swing trading breakouts is gauging market conditions. Swing trading usually thrives in bullish market conditions. So we want to just take a look at SPY, QQQ, CompQX, whatever index you want to look at, just to kind of see where market's at. Because when market's hot, breakouts are hot. So we can see back here from around November to April of this year, we can see SPY was pretty bullish. We can see it's above the 10 and 20 SMA. It's trending higher with occasional pullbacks and then immediately popping right back over that 10 and 20. And the thing is, we never want to trade when the 10 is below the 20. So we can see markets trending higher after this little chop period. We get a breakout back above, and then we can see the 10 and 20 are back above the 50, trending higher, again, pulling back, pretty choppy period here. And then we can see market starts trending higher again, higher, higher. And then around July, it starts leaking again. This was during the recent market crash. The biggest dip since COVID, basically. Nasty pullback right here. All the SMAs are mangled. Price action is way below the 50. We don't want to be trading during this period. Even on this correction right here, we want to still be careful because volatility is so high. So we're going to wait. Okay, price action is back above the 10, 20. And then, okay, starting to fix itself, starting to align. Again, pretty choppy period. Hard to trade breakouts here. And then we can see stuff starts aligning again, trending higher, the 10 and 20, 50 all aligned up, steadily trending. This is what we're going to want to be trading. Breakouts again, they're sustaining a little better. And then again, a little chop right here, pull back to the 50, and then huge bounce with the recent election. Super bullish conditions here. Breakouts have been sustaining super well. A lot of money to be made. And now we're waiting to see if we can get a continuation higher. So once you gauge market conditions and understand that, it gives you the green light, the 10, 20, and 50 are all aligned up, market's trending higher steadily. Now we're going to move on to the next step. Next step of the process is basically looking for leading stocks within leading sectors. I use the BlackRock iShares sectors, and I basically put all the sectors here in a watch list and then organize them by a 20-day percent gain change and a 50-day one. Basically, we're going to click this filter and we're going to look for the leading stocks within the past 20 days and 50. So if we organize them, we can see the sectors that have made the biggest moves in the past 20 days. So we have consumer discretionary, financials, energy, telecom, and small cap. So these are going to be the sectors that are up the most in the past 20 days. And we can also filter by 50. So in the past 50 days, we have telecom, consumer discretionary, tech, small caps, as well as industrials. So those are going to be our leading sectors as of right now. So once you kind of get a feel for what the leading sectors are, we're going to move on to these scanners. So for my scanners, I use a 1, 3, and 6 month scanner. So we're going to pop these down and basically look for our setup. This is the setup we're going to look for. This is pretty textbook. This was Netflix recently. And we basically want to look for stocks that make a big move, pull back to the 10 and or 20-day moving average, creating higher lows, lower highs, building a range right here. You can call this a flag, wedge, pennant, whatever you want to call it. But basically, you want to look for a stock that makes a big move, pulls back, consolidates higher lows, lower highs, and then breaks out on high volume. So think of the setup kind of as like a coil. The stock expands and then starts to contract a little bit. Volatility is contracting, volume is dying out. It's getting tighter and tighter. We can see thin day right here and then breakout on high volume. And then breakout on high volume. So now the stock is breaking out. How do we enter? How do we manage our risk, etc.? So basically for entry, we use an entry strategy called opening range highs. So basically we want to wait for the first 5-minute candle to form and break out of the flag that's forming on the daily time frame. Once it starts to break out, we wait for the second 5-minute candle to form and take out the highs of the first 5-minute candle. So we can see Netflix opened and then the second 5-minute candle broke the highs of this. This is going to be our entry. So we'll round them up just for the purposes of this video. But basically, so 825 is going to be our entry. That's when it broke the opening range high. And then stop loss immediately goes at low of day. So our entry is going to be the high of the first 5-minute candle. Stop loss is going to be the low of the first 5-minute candle. So now that we found our entry and stop loss, how do we position size? So basically, you want to take 1% of your capital. So to calculate 1% of your capital, you're going to want to take your total capital multiplied by 0.01. That's going to give you 1% of your whole capital. We're only ever going to risk 1% per trade or less, never more. So basically take 1% of your capital and then you want to divide it by the entry price minus the stop loss price. So again, we're going to round just for the purposes of this video. Our entry is 825. Stop loss is 820. So that's a $5 difference. So basically, it's going to be, let's say you have a 10K account and 1% of that, it's $100. So you take $100, which is 1% of your capital, divided by the entry minus the stop loss. Again, we're going to round up for the video, but the entry price minus the stop loss price is a $5 difference. So you take $100 divided by 5, and that's going to give you how many shares you should buy. See, people think the amount of equity in the trade is going to be the total amount you risk, but it's actually not. So the amount of equity you put in the trade doesn't matter as long as you're following what the equation tells you. It's 825 multiplied by, let's say, 20 shares. That means you're going to put $20,000 roughly equity into the trade, but that doesn't mean we're losing or risking $20,000. It means 1% of our entire capital is the max loss we can do because we use the equation here to manage our position sizing. So, okay, the stock broke out, you entered with correct position sizing, you're managing your risk. How do you manage the trade moving forward? So, let's say it breaks out, continues for the next couple of days, it doesn't hit your stop loss. After the first 3 to 5 days, you're gonna wanna trim a third to a half. Personally, I trim a third, and then you wanna move your stop loss to break even. So, you secured your profits, it's a riskless trade from now on. And now you're basically gonna wanna trail your runners with the 10 SMA. So you're going to trail, and the price action, as long as it stays above the 10 SMA, you're going to hold it. And the day price action closes below the 10 SMA, that's when you cut the rest of your position. And that's basically it for the entire strategy. There's not a lot that goes into it, but if you guys want to learn more about swing trading breakouts, I'll leave the Discord link in the description below. You guys can check that out. Come live trade with me every morning, everything like that. But yeah, I hope this helped. If you guys want, a more in-depth video, leave it in the comments below. If you guys want to learn how to trade options on the setup and stuff like that, also leave a comment. Maybe I'll do a part two. But yeah, hope this helped. Peace.